The Adani Group is targeting a $100 billion mega capex plan over the next 6 years. Energy will account for 83 to 85% of that number. Vishwanath Nair joins us with more details. Vishwanath, if I'm not mistaken, this would be the largest ever capex announced by any corporate group in India?
That's right. So what's happening here at Adani Group is that a 6-year plan of a $100 billion capex, the largest ever in the history of corporate India, that's coming through. What seems to be happening, and this is after an exclusive conversation that we had with Jugshinder Singh, the group CFO, what he's pointing out is that the funds are going to be entirely be used only for greenfield projects, to set up those greenfield projects. At this stage, there is no acquisition that is being envisaged in the 6-year plan. You know, if something happens, it happens. But at this point in time, this is the plan. How will this investment actually be used? Well, for that, what we understand is that key areas that are going to be a part of this focus is energy infrastructure, construction materials, minings and metals. These are the areas where a lot of this money is going to be used. Now, there's a breakup of sorts. About 83 to 85% of the capital raise will be used for energy and infrastructure. About roughly 10% in construction materials. Metals and mining will account for another 6 or 7%. What they expect is that by 2028, this capex cycle will peak, which means that a lot of these planned investments will peak by then. Towards the end of that 6-year period is where the tail end of this investment will come in. They plan to invest about roughly 1.5 to 1.6 lakh crore in FY26 and every year thereafter. This is up from about 1.2 lakh odd crore that they spend per year currently. How is this investment being funded? Well, according to Adani Group, a bunch of this is going to come from internal cash flows. About 80,000 crore of that 1.5, 1.6 lakh crore number is going to come from internal cash flows. About 15,000 crore is going to come from payments and settlements. That is, whatever businesses you're doing, there will be some settlements coming in. And profits will add another 12,000 to 14,000 crore. Now, what that leaves us with is roughly 40 to 50,000 crore, which will come from external funding that is largely debt. They expect that debt will account only about 30% of this capex plan, while the 70% number is going to come from their own funds. This is a complete reversal of what typically companies do, which is about 30% equity and 70% debt. Now, let's try and understand how this is actually going to benefit the group. Well, the energy investment is going to be focused largely in renewables and storage and building up the capacity there. What they're expecting, what Adani Group is expecting, is that the renewable and storage capacity will rise 7 times from where it is at this point in time. The conventional energy capacity is going to double by the end of this entire capex cycle. The net debt to EBITDA, now that's an important number because that's what we care about when companies raise these large capex plans. That is going to range between 2.5 to 3 times over this entire capex cycle. Depending on where you are in the capex cycle, that number will change. Eventually, that number will come down below 2.5 times. That is what the group CFO of Adani Group is telling NDTV Profit in this exclusive.